Welcome to Markets Now. I'm Michelle Brook with Brad Kooima with Kooima Kooima Varilek. We're leaning higher in just about everything here early this morning, with the exception of the cattle market. And let's start off with that, Brad. Charts look a little tough here in the cattle, and maybe a little disappointment about the Friday cash trade.
I think that's the whole reason, Michelle. Thanks for having me on. Making new lows here just as we go on to it. Typically, when you have a late week cash trade, which is certainly what we had last week, typically what happens is that's an indication that the feedlot has got some resolve, that he's got some courage to pass steadier, lower bids, and usually by late Friday, then you end up with higher money. That was not the case this last week. The South was the first to kind of cave in, if I could use a turn of the phrase, and traded at 185. Not that 185 is such a bad price, of course, but compared to expectations in the futures market, where I think the futures were quite confident that we were going to be $1 higher, I thought that as well. To trade it steady at 185 was disappointing, and I think you can see that reflected in how the futures are trading today. Western Nebraska was actually $1 lower at 185 after being at 186 this week. Now, my little neighborhood basically passed the steady bids. There was some 292 to 294 isolated, but
Yeah.
For the most part, we didn't trade here in the north, in this part of the woods at least. So I think that's what influenced the disappointing opening. Now, step number two. Now that the Packers burned off some inventory, didn't buy very many cattle last week. Futures are still a discount. Can we maybe put together a little firmer week on cash? The way the thing feels right now, this morning, early on Monday morning, it's a long way to go. But I guess if I had a guess, I would still say that we'd have a chance of being a little firmer by the end of the week, just because we're that current here in this part of the world.
Yeah, so let's talk about the chart action. As we said, it looks kind of tough. We went up, filled the chart gap area, closed above it, and now we're back below some of these areas. So what are you thinking?
There's no denying that the December and the February cattle in particular do not look good this morning. Rallied far enough to, like you just described in the December, to fill the gap, then have an outside day reversal down on Friday, and then gap lower today. Feb cattle got up in close to the gap, failed, and also gap lower. This is one of those days where you hope you finish better than you start. It is very, very early here in the session. So we shall see. And don't forget, we are discounted to the cash. So we'll see what side of the market here wins for a minute. The technical trader, I think, is going to be nervous. The fundamentalist is going to hope that, trading at a discount to cash, and at a time when typically Decembers carry a premium, not a discount, that maybe we can, right the ship here so far, but not a good start here to the day for sure.
Although the funds have shed some of their length here, so maybe we won't see quite as much pressure. And then, some of them got out because of some of these demand fears with what was going on with outside markets like the stock market, and that has turned around. So will that keep them there?
I think you make a great point when you bring in the macro element here to the market. Let's hope so. Now, the last week we saw a decent little increase in open interest, particularly in the Fed cattle, and I thought, well, maybe the funds are starting to come back. We're getting some roll here already, pre-roll. That'll be the next thing, sell these by Feb. Most of the year this year, the roll hasn't really hurt at all. In fact, most of the times the market's rallied through it. So we'll see what happens this time. But I thank you for pointing that out. Around here, gas is below $3. How about that? When it's high, everybody talks about it, but when it's lower, it doesn't seem like we get any nod. The Fed announcement where they weren't going to raise rates feels like inflation's in check, and a sharply higher stock market last week. So yes, obviously there's some geopolitical stuff that still continues to go on, but from the standpoint, most of the macros actually should be a bit supportive. So let's see if we can, take a breath here and stabilize. Particularly, it's easier to do that when you're discounted like we are, I believe, Michelle.
Yeah, no doubt. Let's talk about the hog market. Seeing a little strength here, but last week we had a higher weekly close. We went up, made 50% retracement levels, and we couldn't get much farther than that. So is that as good as we're going to do here, Brad, you think?
In a word, yeah. In my opinion, yes. Obviously, I have to hedge, but we feel as though the fundamental situation is not healthy on the hogs. We've got a big supply. You got to move every day. You got to have perfect demand, and whether or not that holds up, we'll see. This is not a great time of year to be revved up either. So I thought that maybe, coming back, steep rally like the hogs are prone to do, rallying just a hair past open those resistance levels. We got a little bit on top, a couple of the moving averages, which is not uncommon. Seems like the hogs like to fool you that way. But now, the action, while we're even doing this interview here, we went from higher to lower just now. So if you're a hedger, let's, keep your tennis shoes tight here. We're going into big supply here. Things got to be perfect. I'd be very sensitive to doing some price protection.
Yeah, and you got to believe cattle sometimes spill over and maybe influence what the hog action is as well. So as you said, now we're trading a little lower. All right, soybeans. We had a nice chart breakout and close on Friday. We're trading South American weather. Some of this China business is being confirmed. How much farther can we move this thing?
Yeah, finally something fun to talk about, right? I mean, it's not everything's negative. Great looking chart on the beans. I think you kind of give the outline. I tongue in cheek. The weather in South America, I guess, is less than ideal. And then that frustrates me, and I'm going to kid about it because I don't even know if it's raining in Iowa most times.
Yeah,
right?
I know.
I live in Iowa. So it's too wet in one place, it's too dry in another place, whatever. This is the time of year where that's what we're going to talk about, unfortunately, until we'll have another report this week. But otherwise, then we're going to, set our sights on what that looks like. On the beans in particular, when you got tight carry out, things have to be good there. Although otherwise, it gets a little explosive. So I think it's a little easier to run that spear a little bit, if it's not perfect, we better build in some premium. And talking about the China business too, which certainly is helpful. Kind of expected, but a relief in a way that finally, yes, I guess they're doing what they said they were going to do. So I think there's a little room to run here on the beans. Actually, for the most part, harvest is behind us. Guys have made the decision either to store or sell. Could you put another 50 cents, say, on the front beans, get 13.80 to 14 cents? I think so. So whether that's enough to drag the corn out of this, sideways, nothing that we've had, we shall see. Huh?
Yeah, that was my question on Friday. Would corn have been up if soybeans wouldn't have had such a big rally? But we did score a bit of a reversal. We held the September low. So now can we build on that, especially since we got, 11.5 million bushels of export business to Mexico this morning. So we must be fairly priced.
I know, and here we are, a whopping penny and 3/4 higher. It takes a bunch of good news to get the corn off its behind here. Great action, Friday's action, go down, test the low, outside day, reversal up. Now let's get some follow through. I was a little bit fooled 2 weeks ago. I thought when we finally closed above $5 that was okay. That's it. The low's in now. But, as a trader or as a hedger, if you're someone that so I feed cattle, right? So I use more corn than I raise. On that side of the ledger, I got to look at the market as having value, thinking that we're certainly down in the bottom third, probably 10% of the price range of the market. And so I think the end user is attracted here, thinking that demand will improve with the price here that we've got, particularly the ethanol folks. Whether we get enough to get a long speculator, like a fund or something like that interested, probably a couple of closes above $5 to get us there, and that feels like that's a stretch. But I think the market too low to sell here for my money.
Yeah, just disappointing to see soybeans up as much as they are and corn really not able to get off of dead center. So
for sure.
All right. We'll watch and see what we do heading into the WASDE report as well. Like you said, we're probably seeing maybe a little squaring ahead of that too.
I'm sure. But, I think that it's easier to maybe get the shorts to cover a little bit in the soybean complex than it is in the corn. It wouldn't hurt our feelings if the wheat would leave us alone a little bit there too, from the standpoint of the corn. Obviously, a lot of wheat, and everybody's got it, and it's cheap, and that seems to be like dragging a piano around.
Yeah, it's been an anchor for sure on corn. Thanks so much for joining us, Brad Kooima with Kooima Kooima Varilek. That's Markets Now.